alpha owner investor. In this video, I want to give you an overview of what we're going to do for the rest of the course. That way you have the end goal in mind while we're going through the rest of the material. So there's three key themes that we'll talk about in this video. Number one is garbage in, garbage out. So we're going to value a stock using this spreadsheet that I have here. And pretty simple. I mean, you put in 9 inputs and it values the stock, right? And it's a powerful but also very dangerous tool because it's very easy to put in, not so great assumptions in here, and then you get a not so great result, and then you don't want to be making investment decisions off of that, right? So we need to be very careful about the assumptions we put in because that's really what's going to drive long-term results. So theme number one, garbage in, garbage out. Second theme is precision versus accuracy. It's really easy to be precise in Excel. We can put in assumptions down to like 5 decimal places, but we do not want to do that. Wall Street generally takes us too far, and they build like 1,000-line Excels. Ours is 66 lines, right? So we're not going to do that. We're not going to build 1,000-line models. With every investment, there's only a handful of things that really matter, and so we're going to try to focus in on those few key things. Okay, so that's theme number 2, precision versus accuracy. Theme number 3 is cost of equity. So the idea here is that some stocks are riskier than others, and so you should demand a higher return for owning riskier stocks. But the question is, okay, how do we quantify that, right? Yes, I get that, a coal miner that has a bunch of debt and is subject to changes in coal prices is riskier than, say, Costco, which has like no debt and is a durable, stable, business model. But the question is, how do we quantify that difference in risk? And that's what the formula for cost of equity will help us do, and that's what we're going to cover in this video. So just as we go through this, this will be a quick one, a nice bite-sized video. Just keep those 3 key themes in mind, right? Garbage in, garbage out, precision versus accuracy, and cost of equity. Okay, so you'll get the most out of this video if you download this spreadsheet on the module page. It should be called Costco model. So I'll give you a couple seconds here to download this Excel file. Okay, so the goal of this course is really simple. We're going to punch in 9 numbers, and I'll walk through what all these things mean. And then it's going to spit out a value for the stock, a fair value, and estimated 10-year returns. And then we can compare that to what the fair return should be for the stock based on the cost of equity, which we'll calculate, the estimated S&P 500 returns, and the latest inflation rate. I mean, you can also add like gold and like 10-year treasuries and like other bonds and stuff here. But this is the end goal that we have, right? And the way we're going to get there is punching in 9 numbers, right? So some of these things you might be familiar with, like the share price or beta, and obviously, the latest inflation print, and other metrics. And some of these metrics, like the share price, beta, risk-free rate, equity risk premium, and the inflation print, we're just going to look that up. Like we're just going to go to Google, and I'll show you exactly, and where to find that information is right here on the right-hand side, right? And we're just going to punch in those numbers. But for these remaining 4 variables, right, the diluted EPS, the return on equity, the payout ratio, and the perpetuity growth for EPS 10 years out, this is going to take a little bit more work, right? So in this video, we're going to just find like I'll show you where to find these first 5 inputs, and then the rest of the course is going to be, figuring out these other 4 inputs, right? So that's how important these 4 are. It's going to take us the rest of the course to really like understand and be careful about what we punch in for these 4 other inputs. Okay, so all right, so for this one, for the share price, we're just going to go open up Yahoo Finance. And The example we're doing now is Costco. So we just go in here and punch in Costco. Ticker symbol is COST. And as of close on May, I believe this is May 13th, it's $504.07, right? So then we'll update this part as well. May 13th. Cool. So that's the share price. So this is the easiest thing to understand, right? So think of every stock like a giant pizza, okay? And that represents the ownership of the business. You know, the same way that you would own your house and you take on a mortgage, right, to buy it. But you still own the equity in the house. And it's the same thing with stocks, with companies, right? But just think of it as like this giant pizza that's sliced into a million different pieces. And each share in a company, right, is one piece of that pizza that's been sliced into a million different pieces, right? So in the case of Costco, let's see, let's see the statistics, enterprise value. I'm just trying to find the total shares outstanding. Here we go. 443 million shares outstanding, right? So Costco has been sliced up into 443 million pieces, right? And one of those pieces is going for $504. That's what this means, right? In the most simple terms, right? But remember, this is easy to find. I mean, and the problem is this is what most people focus on, right? Because it's so readily available. This is the stock chart. But this is not what we're really concerned about. This is merely an input for us to figure out the value of the stock, right? As Warren Buffett says, price is what you pay, value is what you get. So we're trying to figure out the value, but the first step in that is figuring out the price. Okay, the next thing, beta. So the beta, it's right here on the main page on Yahoo Finance for Costco. It's 0.79. Right, so the beta tells us how volatile the stock is relative to the overall market. In this case, the S&P 500, the index. Right, so generally businesses in riskier industries, like mining for coal or digging up oil or biotech companies where there's a lot of uncertainty about the business performance, they tend to have higher betas. Companies that have a lot of debt, that are really levered financially, they tend to have higher betas. Companies that have a lot of fixed costs relative to variable costs in their in the business model, they tend to have higher betas, right? So a beta of 2 generally means the stock is twice as volatile as the market on average, right? So that means on a random day where the S&P 500 is up 1%, a stock with a beta of 2 would be expected to be up 2%. But it cuts both ways, right? So when the S&P 500 is down 1%, stock with a beta of 2 would be expected to be down 2%. But it's not, and this is not like, it's not an exact science. This is just an approximation, and it's based on what the performance has been historically, over the last 5 years, right? And so obviously that can change, but for the sake of this simple valuation, let's just run with the 5-year beta that Yahoo Finance has calculated. Okay, so the next one is the risk-free rate. So this is just the 10-year Treasury yield, the 10-year U.S. Treasury yield, right? So we're just gonna click on this link, and this is gonna be updated every day. So right now, the 10-year Treasury yield is 3.468%. But remember, we're not trying to be like super precise. So even this 0.79, I'm just going to put in 0.8 because I do not care about being extremely precise. My goal is to be accurate, right? So this is 3.5%. Okay. And this is basically what an investor can earn today for the next 10 years if they invest, if they lend the U.S. government money for 10 years, right? So stocks are obviously a lot riskier than lending to the American government. So we should demand a premium to this 3.5% for owning pretty much any stock, right? And so and that's what we're going to calculate in the rest of this video. So the next one is the equity risk premium. This is kind of the spread that the S&P 500 returns are relative to the risk-free rate, right? So this is something that Professor Damodaran calculates every month on his website. And he's a phenomenal resource. I actually took his class when I was at NYU, but it was taught by a different professor. And he actually has a free valuation course on his website that's a lot more in depth. So, maybe after going through this course, if you're, interested in going deeper, this would be a really good resource for you to explore. So, okay, so the implied equity risk premium as of May 1st is 4.77%. Again, we're not trying to be super precise. Just going to throw in 5%. Okay, so this is basically saying that based on where the S&P 500 is trading today, and based on some modest growth assumptions that Professor Damodaran has made, the S&P 500 trades at a 5% premium to the risk-free rate. So right now, based on some reasonable assumptions, you can generally expect to earn an 8.5% annual return owning the S&P 500, right? That's the 3.5% plus the 5% spread that Damodaran has calculated. Okay, and then the last thing that we want to calculate here, or not calculate, but really just look up, is the inflation rate. So this comes out every month from the Bureau of Labor Statistics. All right, so all items inflation is 4.9%, and then the kind of all items less food and energy is 5.5. So let's just call this 5%. So there's something really interesting here that I want to note, right? Which is that right now the 10-year Treasury yield is below the latest inflation print. So that means that investors that are buying and selling the 10-year Treasury bond, the U.S. 10-year Treasury bond, are expecting inflation to come below 3.5%, right? Versus the 5% where it is today over the next 10 years, right? Because if inflation ends up staying at 5%, this risk-free rate is going to be a lot higher, right? And that's going to shift the value of stocks, right? So these are the 5 kind of key inputs that we can just look up, and it's really easy to find these numbers. The rest of these, it's gonna take a little bit more work to figure out what to put in. So in the case of Costco, right? So what we've calculated here with these 3 variables, the beta, the risk-free rate, and the equity risk premium, is the cost of equity, right? So if we scroll down here, fair returns for the stock, right? This is the same as the cost of equity, right? So that comes out to 8%. So if you own Costco stock, you should demand, based on these assumptions, at least an 8% annual return. Okay, so now go ahead and pause the video and download the Spotify and the Basic Fit models that are also on the same page as this video, and just spend like 5 minutes looking up these exact same numbers using these links for Spotify and Basic Fit, and then come back and we'll review it. All right. Okay, so for Spotify, let's update this to 5/13/2023. Okay, so all right, so now you've filled out the spreadsheet for those 5 numbers that we did for Costco, for Spotify and Basic Fit. So now let me go through it and we'll do it together and compare. Okay, so Spotify, go back to Yahoo Finance. All right, this is 142.53. Just make sure. Okay, so this is in dollars. Cool. So 142.53. The beta is 1.76. And the reason for that, right, is because Spotify is a growth stock, right? It's still kind of early, and you can think of stocks as people, right? So Costco is like a 40-year-old middle-aged person with a spouse, kids, a mortgage, right? Spotify is like a teenager. So it's riskier to own Spotify because we still don't know exactly what the kind of steady state economics of the business will be, 5, 10 years down the line. And Costco is also currently generating negative earnings per share. That's what EPS stands for, right? So that's why the beta is higher. It's a riskier stock. So we should demand higher returns for owning it. So the risk-free rate, this is going to be the exact same, right? 3.5%. And the equity risk premium also going to be the same, 5%. And for Spotify, we should demand at least a 12% return for owning the stock per year, right? And they don't pay a dividend, so all of that has to come from growth. Okay, so all right, let's do basic fit next. $5.13, 2023. Okay. Okay, so notice that this is in euros, right? So that's something that we want to be careful about as we go through the rest of this course. Not all stocks are traded in the same currency, right? So this is 37.74. Beta, again, it's really high. So we'll talk about what Basic Fit does as a business. And obviously, for those of you unfamiliar with Spotify, it's a music and podcast streaming service. Basic Fit, just think of Basic Fit as like the Planet Fitness of Europe. They have a bunch of gym locations all over Europe, so it's a low cost gym. So obviously it's a discretionary product. Versus Costco sells like food and things that people need to survive. So and it has a lot less debt in its capital structure versus Basic Fit is more financially leveraged. So the beta is going to be higher. So and the risk-free rate is going to be the same. Now in theory, because it's a different currency, we should do this for euros versus dollars. But because the euro and the dollar, they're just so similar, we're just gonna kind of run with the dollar and the S&P 500 here. But if this was like an Indian stock, right, we would use different risk-free rates. We would use the same risk-free rate, but we would need a different equity risk premium because now on top of the beta of the stock relative to the S&P 500, there's also just the general risk of currency, and different currencies have different inflation rates, and different current countries have different risk profiles related to their currencies. And so that's like a really complicated topic that we're not really going to cover in this course. So maybe we can talk about that on in one of the Q&A sessions, or I can make a separate video about that. But for now, because it's a European stock, let's just run with these assumptions. So again, similar to Spotify, we should demand at least a 12% annual return for owning Basic Fit. So that's it for this video. So if you want even more practice, because this stuff takes some time to sink in, pick a couple companies that where you're familiar with the product but unfamiliar with the stock, with the business, and just go through this this exercise. And the more you kind of run through different examples, the deeper this will sink in. So let me just run through the bottom line, the essence of this video. It's garbage in, garbage out, right? Investing comes down to the quality of the assumptions that we make. Precision versus accuracy, right? Focus on the few things that matter instead of like going really precise and like going into like nitty-gritty details that don't really matter. The third thing is the cost of equity, right? Before analyzing any stock, figure out the cost of equity, right? Figure out what you should demand in annual returns for owning that particular stock, right? So these four inputs, the five that we put in, we can just figure out, we can just look up. The next four, the normalized, the earnings per share, the incremental, the future return on equity, the payout ratio, and the perpetuity EPS growth for the next 10 years, we can't just look up, right? This is where the rubber meets the road with investing and with this spreadsheet. And that's what we're going to spend the rest of the course doing that. But in order to do that, we need to answer those 6 key questions that I talked about, in the training video on the landing page for this course, right? What problem is the business solving for customers? How does the business make money? Can the business defend itself against competition? How fast can the business grow for how long? And what are my estimated annual returns? And what's the overall risk versus reward, right? So those 6 questions, like we can find like those numbers that we're going to look up, that we're going to calculate, those 4 numbers, they'll make a lot more. Those numbers are basically the way that we quantify our answers to these questions. But it's not just about quantifying them. It's also about just understanding the story behind the numbers, which is why we need to answer those 6 questions. And then we figure out the numbers and then kind of see, like, are we being reasonable about the next 5 to 10 years? And then we come back to this tab in Excel, and it's going to spit out a valuation for us. So post all your questions, comments, and random thoughts below. I've opened up the comment section. I just think it's the easiest way for us to engage instead of the Facebook group. So just forget about the Facebook group. Let's just blow up the comment section here and ask any questions, random thoughts, whatever you want. Post it in the comment section, and then I'll get back to you as soon as I can. All right, that's it for this video. I'll see you in the next one.